What's up, YouTube? Welcome back to the Wallet Monkey Show channel, where we give you all the credit intel you need to grow your wallet. So today we're going to talk about the difference of LLCs and S-corps. Pretty in the trenches, granular topic here. So if this doesn't interest you, just tune into one of the other playlists below, or I'll link a card. We've got quite a bit on this channel, hundreds of videos now, covering all topics within the personal finance space. And a common question that you see is, when should I go from like sole proprietor to LLC, and then from LLC to some sort of S-corp or C-corp, right? So anyways, let's quickly talk about that. I'm not a tax professional. I'm not accredited in any sort of way to be giving you this advice, okay? So you'd want to double check all of this with your accountant or tax representative, right? When you are a sole proprietor, you're basically just trading under your name. Sole prop, it's basically your name, but as a representation of a company. Now, this can work extremely good, believe it or not. It's really weird what starts to happen, especially with credit card companies. Like I know Fund and Grow is this used to be their whole business model. I have no idea. This was a couple years back if they still do this or not. But they would just sign you up for everything as a sole proprietor because it's still using your social security number, but you're going to get higher credit limits at the banks. So if that's all you're looking for and you're not really going to do business, then sole prop would be the way to go, because you can get higher limits because it's technically a business, right? Now, as soon as you want protection, limited liability company, limited liability corporation is when you get into LLC, right? And all that's trying to do is separate between I'm a person with a social security number and I am a company with an EIN number, which is essentially the social security number for that business. So that's the difference between the two. Now we can take that LLC and we can build out vendor accounts, we can give it an address, a phone number, a website, and turn it into a legitimate, let's call it business, not just trading under our name. And we can start to build business credit on that entity. So now that entity can go and get business credit over here without me needing to put my name on it as a PG at all. I can just not fill out that information on the application, and if this business stands on its own, has a Paydex score, has Intelli score through Experian, has all these different scores, it's gonna be just fine, right? So that's why we even want to get into this in the first place, is because it opens up a ton of new opportunities for business funding, business credit cards, and to help you grow the business. That's the whole point. The SBA's got tons of programs, so there's a lot here that we're now opening the doors with by simply getting into, creating and establishing a business, right? All right, so let's get into this now. The reason why you'd want to jump from an LLC to an S-corp, which is the topic that I gave you for this video, is when are you going to jump from LLC to S-corp? Well, you need to understand how taxes are taken into consideration with both, so then you can make that decision for yourself. So I'm not going to give you it's got to be at 100,000. That's when we make the jump. It could be a little bit less. It could be more. I don't know. For you, it's going to be different. So all I'm going to do is just break down the math and explain that to you. And that's it. And from there, you can decide. Yeah. All right. So plus, we've already kind of spoiled it by giving you all these numbers up front. Hypothetical. Your business makes $100,000. Okay, there's what's called standard deductions. For a single person, it's $12,550. For a married couple, it is $25,510. Again, there could be other deductions you're doing. We're just taking basic deductions. Yep, and the next one is QBI, Qualified Business Income Deduction, and you can do 20%. So we now take off standard deduction, QBI, and we are left with $69,960 of taxable income. Now on that, we have to pay self-employment tax of 15%. Keep in mind, half of that is deductible, but it's deductible after the fact, so I'm still paying that up front. Make sense? And so that comes out to $10,704. After I get the deduction, then that's only $5,352. All right, so $69,960 minus the $5,352 gives us $64,608 final taxable dollars. Now, federal tax rate. We're gonna hit into several categories. We're gonna hit into the 10%, the 12%, and the 22%. Here are those fees, those tax rates. That's $995, $3,669, $5,298. So total federal tax is $9,962. Then we got the self-employment tax, $10,704. And you're gonna have state tax. Now, I chose California because 2 reasons. One is there's the most amount of businesses registered in California, and it's the most expensive state to be in. So I wanna give you the worst case example or worst case scenario for you to get these numbers off of. All right, so that is $2,080.32 for California state tax, bringing our grand total taxes to $24,826. So you're not a 6-figure earner anymore. You are a 5-figure earner. You are an $84,000 earner now, right? That's what that looks like. On the S-corp side, you have to run a payroll. And so in California, the fair value is ballparked at 30%. Okay, that is the accepted amount. So to be sure, I just based it off of 35%. Now, this payroll amount might be different in a state you're in. You might be able to get away with a small amount of payroll. Like some people, this is where you start to run into problems with potential audits is, maybe just doing 10% payroll. It's like, nobody's taking 10% payroll. So if you're going with a ridiculously low amount, understand that you do open yourself up to risk of being audited because they're wondering why you're taking such a small payroll percentage. So I think 30% is a good number. I would probably use that as some sort of average across the boards in every state, right? All right, so $35,000 as the payroll. Again, we've got our same $10,000 income example. $35,000 is going to be payroll. So now we got to break down 2 little columns here. And the first one is payroll income. So $35,000 is payroll tax. Payroll tax is going to be withheld. And so we've got 7.65% as employee tax, and then we've got 7.65 as the employer as well. So that's 15.3% total tax, okay? And what that would be is $5,355 in payroll tax. Now keep in mind that's the same as an LLC, but the difference here is that I'm choosing how much I'm paying taxes on because I'm choosing how much is my payroll income. Make sense? So that's where the big distinguisher comes in at. It's all going to be based off of what I say and declare is the payroll income, not off of the total amount like with the LLC like you just saw. So that's the big distinguishing mark. So it's the same 15.3%, it's just I get to choose on how much. Make sense? Okay, so $5,355 in payroll tax. Next, federal tax rate. We're going to fall into the 10% and the 12% buckets. So that's $995 and $3,006. Total federal tax would be $4,001 at that point. State tax in California, again, that's $887. Payroll tax, $5,355, gives us a total of $10,243 in payroll taxes. We also now need to come over and do the rest on the business income side, which there's only $65,000 left of net business income now. We take our standard deduction, just like we did before with the LLC, of $12,550. Our QBI is going to be $10,480. So our final taxable number is $41,960. We're going to fall into 3 federal tax categories again. The 10%, 12, and 22. That's going to be $995, $3,669, and $315, bringing our total federal tax rate to tax amount to $4,979. Add in our California state tax of $1,336, gives us a total business income tax of $6,315. The total is $16,558 between the two. Yeah, between the payroll tax side and the business tax side. Now, let's bring that back and compare it up against on the LLC side. See the difference? So we're talking about a difference of $24,826 and $16,558. So let's just subtract these two. I did not do that. 32 minus 16,558. That's a difference of $8,268. Now for you, this might be a huge amount, or for you, this might not be a lot at all. And again, it's just going to depend on how much gross the business has, how much money the business is making. All of that's going to matter. What you see the next 12, 24, 36 months doing, all of that's going to depend and make the choice easy or hard for you of where when we're going to upgrade. And this is a conversation that you should be having with your tax professional, not me, and definitely not in the comments section. So anyways, I'm just giving you this for reference sake and reference sake only. I shared it in the Discord. A lot of people were really interested, so I figured, you know what, let's shoot a video and upload it to the channel as well. So there you go. There's the tax breakdown, or the math breakdown of the taxes and the difference between LLC, S-corp, and hopefully that helps you make your decision. I would strongly suggest that, if anything, you take a screenshot of this and share it with your tax professional, have that conversation with them of, is it time for you to jump? You probably already were having those conversations. If it really is, and they were really good at their job, they would have already brought this up to you. So if they didn't, maybe it's time for a new tax professional, but that's entirely up to you. Comment below if you got something to say, or you just want to help the algos. Click the like button, does the same thing, helps get this in front of more people. And if you're brand new here and you like this sort of thing, hit the subscribe button and click the bell notification so you don't miss out on any future videos. See you, my friends.